Welcome to the deep dive. So we're kicking off what promises to be, well, one of the most strategically complex years in recent memory. It feels like a year that's going to demand a totally new level of insight, and proactive decision-making from every single investor and leader out there.
Indeed. What we're trying to do today is pretty ambitious. We're looking ahead to 2026, a period that's really defined by these profound splits in monetary policy, entrenched geopolitical rivalry, and, it's the elephant in every room, the extreme volatility around the artificial intelligence investment boom.
Okay, let's unpack this. The foundation for our deep dive today is, well, it's built on a stack of analysis from Goldman Sachs. We've got their big 2026 investment outlook, their reports on generative AI hype, and their analysis of this whole AI bubble debate. But, just reading market forecasts isn't enough when the future feels this chaotic. Our mission is to filter all of that data through a totally different strategic framework.
And that framework is the pioneering R&D on what's called forward AI, which was developed over decades by Dr-Eng-Prof Yogesh Malhotra. He has spent years building systems designed specifically to manage these environments that are just chaotically uncertain. He calls them wicked environments.
And the level of immediate uncertainty is almost dizzying. On one hand, you have global central banks trying to execute this really delicate shift from hiking to easing. On the other, you've got high tariffs hardening supply chains globally, and we're seeing the most intense, focused tech investment boom since the first internet explosion.
It creates this state of, simultaneous maximal optimism and deep, deep existential risk.
Which brings us to the core question, and I think it's a question that you, the listener, have to answer for your own roadmap. Is this AI boom a genuine productivity lifting platform shift? Goldman Sachs economists are estimating it could boost U.S. productivity by an incredible 1.5 percentage points annually over a decade. That's trillions in value. Or is it fundamentally a financial bubble, just waiting for that inevitable pop, as some of the top technical experts are arguing, totally detached from any actual breakthroughs?
What's fascinating here is that our sources, they reveal the answers probably. Both. You've got the market projecting these tangible, colossal productivity gains and underwriting a multi-trillion-dollar investment cycle. But at the same time, you have leading technical skeptics warning that the foundational intelligence of these LLMs is fundamentally overhyped, and that the financial structure holding it all up is circular and, frankly, very fragile.
So we need a tool to manage this high-stakes, polarized environment.
Absolutely. The traditional approach, and this is what Dr. Malhotra calls backward AI, based entirely on historical data and prediction, is guaranteed to fail here.
Yeah.
We need the forward AI framework. It focuses on the anticipation of surprise and the design of these quantum-augmented self-adaptive networks, or QASANs. And this allows you, the investor, the leader, to manage that dynamic uncertainty and really position for outcomes, not just data inputs. So before we really dive deep into the whole AI dilemma, we have to set the stage. The investment environment for 2026, it's going to be defined by this really complex macroeconomic backdrop, especially the shifts in global central bank policy.
It really feels like the entire global financial system is running on 3 or 4 different speeds right now. We need to understand that transition from the aggressive tightening we saw just a few quarters ago to this easing environment that everyone's anticipating for 2026.
Exactly. Let's start with the U.S. monetary policy outlook. Goldman Sachs previously had a pretty high terminal rate forecast for the Fed, right? Up in the 5.25 to 5.5% range. And this was necessary. It reflected higher than expected growth and the Fed's own, hawkish signals reacting to that sticky inflation. However, they also significantly lowered the 12-month recession odds, all the way down to a modest 25%.
That reduction in recession risk, that's key, isn't it? It implies that the economy has sort of successfully digested all those rate hikes without a massive shock.
Precisely. The confidence comes from the belief that, tighter bank lending conditions from the rate hikes will only impose a modest drag on GDP, not a catastrophic one. And we've also seen inflation expectations revised down. The day 2023 core PCE forecast, which is a favorite for the Fed, was lowered to 3.5% year over year. It signals a cooling, even if it's slow.
Okay, so now looking forward into 2026, the whole discussion just flips. We're moving from that hold and hope phase to an active easing phase. What's driving that?
The labor market.
Yeah.
It holds the key to the pace and the scale of any Fed easing. The GS forecast suggests the Fed will execute 2 potential rate cuts in 2026. And these cuts, they're not driven by some severe economic collapse, but primarily by the anticipation of, sustained labor market weakness. And that's expected to stem from a few structural factors.
I see the dilemma there. If the Fed is cutting rates because they expect labor market weakness, maybe because AI is starting to automate white-collar jobs, but the AI also delivers a massive productivity boost. How do they balance that risk of a policy error?
That is the critical uncertainty. If those AI-driven productivity gains accelerate faster than the labor market weakens, the Fed might ease too aggressively and risk reigniting demand-side inflation. But on the other hand, if the labor market weakens quickly because of automation, but then tariff costs push inflation higher anyway, well, they face stagflationary pressures. The forecast is basically betting that the labor weakness will be the main driver, allowing the easing cycle to begin, as long as, geopolitical and tariff-induced inflation doesn't become the core problem.
So that link between AI adoption and the future of work is a major input for every single Fed decision from here on out. Meanwhile, the global picture is even more fractured. We're seeing the significant central bank divergence among the G10 countries.
And this divergence, this is a defining characteristic for fixed income investors in 2026. The expectation is that 9 out of 10 G10 countries will be actively cutting rates in 2025 and then carrying that momentum into 2026. This sets up a really challenging environment for any kind of passive, broad brush fixed income strategy.
So who are the outliers here? And what does that mean for investment strategy? Japan and Europe are the key splits, right?
Correct. Japan is the clearest outlier. After decades of fighting deflation and using massive quantitative easing, Japan is finally on track for a higher rate regime. This is backed by firm inflation and stronger than expected GDP growth. It signals a fundamental shift in their monetary policy, moving toward a more normalized interest rate environment. We expect to see a yield curve control adjustment, maybe shorten the target maturity on their bonds from 10 years to 5 years, which signals they're serious about higher rates.
And Europe. The ECB has been, well, notoriously hawkish. They're often seen as overreacting to minor signs of inflation.
The ECB is expected to maintain an extended pause. This is driven by surprising economic resilience. The Eurozone hasn't folded as quickly as many thought, and a continued hawkish reaction function. The market might be underestimating the probability of easing if inflation undershoots the target significantly, but for now the expectation is stability. They're waiting for definitive data.
So what does all this divergence mean for you, the listener? If you hold bonds or manage duration, we mentioned the jargon, diversify duration exposures and position strategically across sovereign curves. How do we explain that in plain English?
It means that fixed income investors need to be really active in choosing how long they were locking up their money. That's the duration in different countries. If the U.S. Fed is easing, U.S. bonds look attractive. If Japan is hiking, their shorter-term bonds might look more volatile. Since one country's bond yield is moving opposite to another's, you can't just buy a global index. You need active management to target specific curves. Buying short-term debt in one market and long-term debt in another to optimize your returns based on those anticipated rate changes.
That makes perfect sense. So monetary policy is basically setting us up for a game of selective duration. Okay, let's shift from monetary policy to the fundamental reshaping of global trade and geopolitics. The impact of high tariffs, it's structurally changing where capital is spent, totally independent of interest rates.
This is where it gets incredibly important for long-term supply chain strategy. And the data is just shocking. The U.S. effective tariff rate have hit 18%. That is the highest average tariff level consumers have faced since the Smoot-Hawley Tariff Act of, 1930 and 1934. The geopolitical dynamics, especially the U.S.-China decoupling, are now decisively outweighing the forces that favor, tighter global integration and efficiency.
That 18% rate immediately flags a massive, persistent downside risk for 2026 growth and inflation. But the interesting detail the sources provide is that companies have used these proactive mitigation strategies, like relocating production, supply chain adjustments, to protect their margins so far.
The operative phrase there is "so far." The risk is that these tariff costs are only delayed, not eliminated. If companies can no longer absorb these costs through efficiency gains, we could see a greater, more aggressive pass-through to consumer prices in the coming months of 2026.
And if we see that tariff cost pass through, what's the pain point for the average consumer? Is it just holiday shopping? Or are we looking at persistent core goods inflation, putting pressure on that 3.5% PCE forecast?
It's likely persistent core goods inflation. We're talking about manufactured inputs, electronics, clothing, items deeply embedded in the supply chains we're now decoupling from. This requires organizations to fundamentally change their capital allocation. Resilience and geopolitical alignment, they have to take priority over sheer cost efficiency. The investment thesis now explicitly includes national defense, economic security, and the robustness of the supply chain itself, which we'll get into more later.
Speaking of consumer sensitivity, we need to look at consumer health in the U.S., especially since consumption is the engine of U.S. GDP. And while overall U.S. consumer confidence is robust, there are these distinct signs of weakness emerging among lower-income households.
The U.S. consumption story is truly a tale of two spending realities, and it's critical for modeling 2026 resilience. The wealthiest 20% of U.S. households, they account for 40% of total consumption. This concentration among the affluent means their persistent spending acts as a significant buffer for overall GDP and shields the economy from widespread spending moderation.
And conversely, the lower income groups who are showing weakness, they account for less than 10% of total consumption. So while their pain is real, its drag on the overall GDP number is, well, statistically limited.
That's the key distinction. However, if that delayed tariff cost pass-through we talked about accelerates in 2026, it could start eroding the purchasing power of the middle class. And that could lead to a period of more moderate spending across the board. The buffer provided by the top 20% is strong, but it's not invincible.
And we are seeing increased auto and credit card loan delinquencies, especially among subprime consumers. That sounds like a systemic warning sign.
It is a sign of stress, but the sources clarify that much of this is attributed to credit score migration effects post-pandemic and the larger average size of auto loans. It's not seen as widespread fundamental household credit stress across all income brackets. It's more of an idiosyncratic risk within the consumer credit sector, not a systemic threat to the entire spending engine. But it certainly adds to the complexity. The environment is stable, but fragile in specific areas.
The macroeconomic foundation seems, well, relatively stable, buffered by wealthy spending and anticipated Fed easing, even as tariffs reshape trade. But on top of this foundation, we are building a massive technological tower. Let's dive into the sheer size and potential of the generative AI investment wave. Goldman Sachs analysts are extremely bullish, framing it as a shift comparable to the adoption of electricity or the PC and internet boom.
Yeah, the comparison to past platform shifts is instructive because it contextualizes the potential capital expenditure. With electricity, it took decades to realize the full productivity benefits. With the internet, value creation was highly concentrated and followed a boom-bust cycle. GenAI is unique because the transformative potential is already translating into measurable, real-world productivity increases now.
We aren't waiting for the long-term potential. Rangan, for example, he cites anecdotal evidence of developer productivity already increasing by 15 to 20%, just by using generative AI tools to automate, rote manual coding processes.
That is an immense immediate cost-benefit ratio. We're talking about software that often costs, $10 to $20 per developer per month, yet it delivers hours of time savings daily. Applying that 15 to 20% boost across the vast global knowledge economy, legal, finance, R&D, that's how you get to these huge macro-level estimates.
And the macro-level estimates from GS economists are just staggering. They estimate that widespread AI adoption, which they assume happens over a 10-year period, could boost U.S. productivity growth by 1.5 percentage points annually.
That sustained productivity uplift is monumental. Historically, productivity growth has often hovered around, 1 to 1.5% annually. Adding another 1.5 points on top of that fundamentally alters the potential for GDP growth and corporate profitability for the next decade.
So what does that structural change mean for equity markets, specifically for the S&P 500?
Well, under these productivity assumptions, widespread adoption of AI could lift the long-term S&P 500 EPS compound annual growth rate by 50 basis points, taking it up to 5.4%. Furthermore, GS estimates that the S&P 500 fair value would be 9% higher than current levels, holding all else equal. This suggests S&P 500 earnings per share in 20 years could be 11% greater than our current baseline assumptions.
So the core thesis is this. AI will deliver enormous economic value creation, an estimated $4.5 trillion in economic value in today's dollars, maybe $20 trillion in present discounted value in the U.S. over the long run. The market is pricing in a revolutionary future.
And this optimism is fueling an unprecedented capex boom. It's not just talk, it's capital expenditure on a massive scale. The fact that analysts have consistently underestimated AI hyperscaler capex every quarter for the past 2 years, that signals continued upside risk to the durability of the AI trade. The building hasn't slowed down.
It's fascinating how concentrated this investment is. The 5 largest AI hyperscalers, Amazon, Google, Meta, Microsoft, and Oracle now account for 27% of the entire S&P 500 capex spend. That is a colossal share of corporate investment driven by a single technology theme.
And the sheer projected volume of spending is immense. Hyperscaler capex alone is projected to total $1.4 trillion in the 2025 to 2027 period. To put that in perspective, that's approaching the size of several major global economies.
And let's focus on a crucial detail that distinguishes this boom from previous bubbles. Much of this capital is coming from the hyperscalers' own robust cash flows and free cash flow generation.
This is a point Cash Rangan highlighted as potentially what ultimately saves the day.
Ah,
Unlike the late 90s dot-com era, where firms often had little to no revenue, the capital being spent today is being deployed by highly profitable companies with solid balance sheets. They are funding their own infrastructure build-out with operational cash flow, which significantly reduces the systemic risk of leveraged speculation. If the underlying investment proves justified, this internally funded capex provides a very strong foundation.
looking at where this massive capital is being deployed, investors see opportunities across the entire tech stack, which is why the boom feels so broad, even if the capex is concentrated.
Yeah, we can categorize the investment opportunities into three layers. Layer 1 is the foundational and infrastructure layer. This includes the large tech companies developing the core foundational models, GPTX, Llama, Gemini, and the essential picks and shovels businesses. The semiconductor companies, especially those focusing on accelerators and GPUs, the cloud hyperscalers that host the models, and the infrastructure companies providing the data plumbing. They are clearly best positioned to capture gains during this high-spending build phase.
But investors often talk about the bigger long-term disruption happening in layer 2, the application layer. This is where the money eventually has to be made by end users.
That's where the market is less sure today and where the most creative disruption is happening. Sarah Gual argues that the biggest long-term opportunity lies in the application layer, across specialized verticals like security, legal services, complex CRM, advanced data analytics, and bespoke content generation. These are areas traditionally served by human services that are now being rapidly transitioned into software as a service models.
Why are investors so unsure about this layer if the potential is so high?
Because it requires significant creativity to deploy these non-deterministic models AI that sometimes gives a different answer to the same prompt-in, reliable production use cases. I mean, if you use a non-deterministic model in legal discovery, you need strong guardrails, human oversight, and validation. That engineering hurdle is slowing down adoption and making it challenging for incumbent companies to pivot quickly, which is why many promising application companies are staying private longer and pushing deeper into the private capital stack.
That explains why public market exposure is so heavily tilted toward hardware and foundational models right now. But we also need to consider the infrastructure multiplier effect.
This is the hidden cost and the hidden opportunity. Running generative AI at scale demands exponential increases in compute power and data storage. As Rangan observed, when cloud computing first emerged, it was supposed to simplify IT. Instead, throwing GenAI on top of existing cloud architecture, it just exponentially increases the complexity of interactions. The models are nonlinear, unpredictable, and they demand entirely new tooling.
This is creating a field day for the next tier of software companies.
Precisely. This is the opportunity for the infrastructure software companies that provide diagnostics, tooling, measurement, feedback loops, and stabilization. If you have a massive LLM running across thousands of GPUs, you need incredibly sophisticated software to ensure data integrity, manage latency, and fix things when they inevitably break. They are the secondary picks and shovels, and their value often gets overlooked amidst all the excitement over, say, NVIDIA. And that massive investment thesis, driven by potential productivity and trillion-dollar capex, that brings us immediately to the necessary critique. History shows that high expectations often run far, far ahead of reality, leading to a profound collapse of confidence. We have to engage with the AI bubble debate.
The classic historical parallel is the dot-com boom, right? Where high expectations, even with strong sales growth, led to that sharp 50% plus contraction in PE multiples and the plunge in share prices. Are we just repeating 1999?
Well, Peter Oppenheimer and other analysts on Wall Street argue that the U.S. market is not yet in a full-blown bubble, despite some troubling similarities. We see the classic characteristics that rhyme with previous bubbles: high concentration of value in a few companies, stretched valuations in some niche areas, and extremely high capital intensity.
But what are the crucial differences that prevent this from being a 2000 repeat?
The differences are fundamental. First, today's growth is fundamentally driven by robust earnings, staggering profit growth, and strong balance sheets, as we discussed with the hyperscalers funding their own capex. The 90s bubble was defined by non-revenue firms commanding irrational valuations based on pure hope. Second, the valuations, while high, are not historically extreme in aggregate. The Magnificent 7 median PE is around 25x, and that's excluding Tesla's unique situation.
25 times earnings is certainly high, but you're saying that's roughly half the peak we saw in the late 90s bubble.
It's exactly. The largest stocks during the late 1990s bubble peaked at a median PE of around 50x. Additionally, market-implied long-term earnings growth expectations, they stand at 10% today. That's modestly above average, but it's far below the 16% reached at the absolute height of the 2000 tech bubble. So, while caution is necessary, the aggregate market metrics do not suggest that parabolic exuberance of 2000 or 2021.
So the financial analysts are cautiously optimistic that the fundamentals justify current price levels, even if there is some froth in small segments like certain quantum computing baskets or speculative meme stocks. But this financial optimism is just radically contradicted by the technical experts.
This is where the tension becomes acute. We have to turn to the skeptical voices, specifically Gary Marcus, professor emeritus at NYU, whose technical skepticism really attacks the very premise of the boom, the supposed intelligence of the AI systems themselves.
And Marcus's primary assertion is that the hype around AI's intelligence is just definitively overblown. How does he break down the technical flaw of generative AI for the average user?
He argues that current Gen AI remains autocomplete on steroids. Its sole function is statistical prediction, predicting the next word or pixel in a sequence based on vast quantities of historical data. Crucially, it lacks an internal model of the world. It doesn't understand cause and effect, basic physics, or abstract concepts like trust or intent.
Can you give us a concrete example of how this lack of a world model impacts a high-stakes application, like, say, financial or legal modeling, where you need reliability?
Take legal discovery. If you ask a current LLM to summarize a contract or identify a precedent, it might generate a perfectly fluent, grammatically flawless response. But because it lacks a deep causal understanding of legal logic, the world model of the law, it may hallucinate a non-existent clause or cite a case that was overturned 3 years ago. You never know what you're going to get. This unreliability means human oversight must remain paramount, which immediately caps the productivity gains and undermines the rationale for trillions in investment aimed at total automation.
That technical flaw really undermines the promise of artificial general intelligence, or AGI, which is often the justification for the trillion-dollar valuations being assigned to these foundational model companies.
Absolutely. Marcus emphasizes that while AGI might arrive this century, we are still decades away. He notes that the industry itself is finally beginning to acknowledge the fundamental failures of pure scaling laws. The foundational belief was that bigger models would always yield better, smarter results.
But that faith has broken.
Yes. Recent disappointments surrounding releases like Llama 4, Grok 4, and even expectations around GPT-5, they show that diminishing returns have entered the mainstream discourse. The systems are stalling out on tasks requiring true reasoning, planning, or complex synthesis. They're giant approximation machines, easy to monetize initially, but they're hitting a ceiling on the path to true intelligence.
And that stalled progress has caused a quiet but significant shift in the industry's R&D focus.
It has. They're moving away from pure scaling toward integrating symbolic tool systems that incorporate actual rules, logic, and structure. This is the basis of neurosymbolic AI, and Marcus cites breakthroughs like AlphaFold, which models protein folding using symbolic logic, as the bite example of this necessary hybrid approach. It's a promising but inherently slow step toward true AGI.
Okay, now let's turn to the financial side of the skepticism, specifically the chilling analysis from David Kahn, a partner at Sequoia Capital. He raises the alarm on the capex circularity concern.
Kahn's analysis is brutal and based on simple economics. He argues that the current ecosystem is fundamentally circular and requires constant massive propping up by new investment. He estimates that in the current supply chain, from the end customer's dollar flowing down to the cloud provider and the chip designer, for every dollar that flows down the supply chain from the end customer, NVIDIA keeps $1.20 today.
That statement is it's shocking. If a company's keeping $1.20 for every $1 spent, what does that mean in practical terms for the system's sustainability?
It means the flow of revenue generated by actual users, the top of the supply chain, is insufficient to justify the current prices and margins of the hardware providers at the bottom. The massive capex is being funded by hope and venture capital, or the hyperscalers' own deep pockets, not yet by the actual profits generated by the AI applications themselves.
Let's walk through the math clearly. Kahn estimates that doubling NVIDIA's run rate revenue gives you the approximate total data center spending in a given year. And if you double that data center spend again, That is the revenue needed to pay back the investment over time.
Exactly. Using forecasts for future data center capacity, the implied revenue needed to justify the projected $4 trillion of data center spend by 2030 puts us at AI's $8 trillion question. That is the revenue base that needs to materialize from developers and enterprises actually paying for services, just to justify the investment in infrastructure.
And currently, we are nowhere near that scale of enterprise and developer revenue, despite the massive capex being deployed.
That's the crux of the financial bubble claim. Marcus, synthesizing this technical and financial flaw, asserts that the industry's trillion-dollar infrastructure investments are dwarfed by the few billion dollars in revenue currently generated from developers. Therefore, the lofty valuations are entirely detached from actual profits and rely entirely on future, unproven breakthroughs, a pure hope and hype cycle. This makes the entire investment environment, in his view, a Wile E. Coyote moment, where the industry has run off the cliff and has yet to look down.
This is the moment of maximum tension. We are stuck between two competing realities. The investment analysts who say the boom is justified by solid earnings and massive productivity potential, and the technical experts who say the technology is flawed and the finances are a circular bubble. If you're an investor or a decision maker, how do you navigate a market where the potential upside is enormous, but the core foundation is deemed fundamentally unsustainable?
You can't rely on traditional risk management or historical prediction. This is precisely why a paradigm shift in thinking is required. We have to move away from systems built solely on predicting a bygone past.
Okay, let's clearly define the problem Dr. Malhotra identifies, the backward AI trap.
Backward AI is the definition of current LLMs and GenAI. They are statistical machines focused entirely on predicting a bygone past using archived historical data. This approach is mechanistic deterministic. It works well only in highly stable, predictable environments. But in a wicked environment, one defined by unprecedented chaos, geopolitical surprise, and fundamental technological discontinuity, backward AI is, and I quote, guaranteed to fail.
The analogy Dr. Malhotra uses is compelling. If human civilization had relied on an AI that only used historical data, we would never have invented fire or the wheel because there were no data sets or pictures of them beforehand. Those breakthroughs came from human intuition and creativity, not from statistical analysis of the past.
The solution, therefore, is a foundational shift to forward AI. This is not an incremental update to a model. Dr. Malhotra characterizes this transition as the most significant paradigm shift in artificial intelligence since the advent of computing itself.
That is a powerful statement. How does forward AI redefine the goal?
The shift is profound, moving from a data-driven focus to an outcomes-driven focus. In the backward AI model, the value is perceived to be in the inputs, the trillions spent on data, training, and compute. In the forward AI model, the value is purely in the outcomes, how robustly, competitively, and sustainably those outcomes are achieved, especially when you're faced with surprise.
So the core strategic objective of forward AI then becomes the anticipation of surprise.
This framework, which Dr. Malhotra pioneered since the beginning of the World Wide Web, is about building organizations that not only survive uncertainty, but proactively thrive on uncertainty and create the digital future. This fundamentally replaces the obsolete goal of trying to create the perfect 5-year plan in a world that is just moving too fast and is too chaotic to predict linearly.
And the practical vehicle for this is the development of QASANs and quantum mines.
QASANs quantum-augmented self-adaptive networks are designed to build upon and maximize quantum mines. Now, when we talk about quantum mines, we're not talking about sci-fi. We're talking about the latent capabilities inherent in human systems. Intuition, creativity, insight, ingenuity. These capabilities are much, much beyond the current mechanistic deterministic models of AI because they can deal with non-deterministic reality and generate novel solutions.
So forward AI is about augmentation, not automation. That brings us to the crucial difference between augmentation versus automation.
Exactly. Automation, particularly with current hallucination-prone LLMs, has limited benefits and introduces inherent risks. Augmentation, conversely, focuses on emulating and enhancing human intuition and sense-making, not replacing it. The ultimate goal, and this is rooted in George Kelly's theory, is to design systems that help humans become better scientists.
For the listener, how do we apply George Kelly's theory here?
Well, Kelly proposed that humans are constantly constructing and testing their own reality by building, testing, and revising these personal constructs or mental theories to predict the future. A forward AI system provides the tools, the QASANs, to rapidly test and refine these human-generated theories against dynamic uncertainty. It helps you run 1,000 what-if scenarios that your intuition suggests are possible, even if they aren't reflected in the training data.
This moves us beyond simply reacting to changes to proactively engineering them, which is the proactive paradigm engineering approach, leveraging the Hegelian synthesis.
This is the strategic antidote to the wicked environment. In traditional Kuhnian science, progress is reactive. You wait for a crisis to force a revolution or a paradigm shift. But as Dr. Malhotra states, we can't afford to wait in today's chaotic world. The Hegelian inquiring system is designed to proactively engineer the paradigm shift.
Let's use the current AI debate as the perfect example of this Hegelian conflict.
The current idea, the thesis, is that AI is the greatest productivity tool ever and warrants trillion-dollar valuations. The intentionally provoked opposite, the antithesis, is that AI is flawed, technically limited, and a circular financial bubble. You don't ignore either side. The conflict itself is the engine, forcing a gestalt switch to create a radically new synthesis. A robust, non-deterministic system designed to harness human intuition while managing massive uncertainty.
So backward AI is Lockean. It seeks consensus and pattern prediction. Forward AI is Hegelian. It seeks necessary conflict to create novel, resilient solutions.
In this framework, it's not just philosophical. It's designed to manage real-world, unprecedented risks, dynamic uncertainty, rapid change, adversarial uncertainty, malicious actors, and quantum uncertainty, nonlinear, non-deterministic reality. It is crucial to note that Dr. Malhotra's focus on these fundamental types of uncertainties leads global standards like ISO 31000 by over 25 years. This framework is essential for handling the failures and breakthroughs inherent in the AI investment cycle.
So, what does this all mean? How do we apply the synthesis, the massive financial projection, tempered by the technical skepticism, managed through a forward AI lens to our investment choices for the next year?
It means that passive strategies, which rely on the stability of a broad index, are increasingly insufficient in a market defined by divergence, tariffs, and potential bubble risk. We need active investing amidst elevated valuations.
The key equity indices, the S&P 500, STOXX 600, Japan's Nikkei 225, have all repeatedly set new all-time highs. When traditional investments look this expensive, the risk is concentrated, and active, disciplined investing based on rigorous analysis of business fundamentals is paramount.
We have to focus on areas where the growth potential hasn't been fully priced in, or where specific catalysts like the anticipated rate cuts are most impactful. Small-cap equities really stand out in this context.
Why small caps now? Aren't they more sensitive to economic downturns?
They are, but their valuations in the small and mid-cap space look attractive, given the strong outlook for earnings and the anticipation of Fed easing in 2026. Smaller companies, particularly those involved in the picks and shovels side of AI innovation, stand to benefit disproportionately from cheaper borrowing costs and a pickup in deal-making. However, this demands active security selection because of the idiosyncratic risks.
Yeah, the whole meme stock phenomenon highlights that passive approaches are dangerous here. You need to know exactly what you own in small cap land.
Exactly. And in the private markets, venture capital valuations remain incredibly high, but they're expected to remain range-bound absent of a massive macro shock. Investors should maintain a focus on assets with strong fundamentals, clear forward growth prospects, and crucially, strong founding teams.
This sounds like applying the forward AI mindset to vetting founders.
It is. As the sources advise, you have to actively back the jockey more than the horse. In a chaotic environment, the true value lies in the leadership's ability to use their quantum mind, their intuition and ingenuity, to anticipate surprise and pivot effectively. The trend is for companies to stay private longer, using additional private capital to fund those higher growth trajectories before an eventual M&A or public offering.
Let's look at the immense second-order effects of the AI boom. The energy sector. The power demand megatrend is a generational shift driven entirely by the scale of compute needs, and it will require massive capital investment outside of technology.
The scale of the power demand is astonishing. AI capex is driving generational growth in global power demand, with data centers alone forecasting over 175% growth in demand by 2030 compared to 2023 levels. Currently, data centers consume about 3% of U.S. power. That's expected to reach 8% by 2030.
That structural mismatch is what creates the investment opportunity, especially since U.S. power grid infrastructure averages 40 years old. It's a bottleneck.
This necessitates a holistic investment approach, focused not just on low-carbon generation, but on the massive, crucial grid enhancements needed to get that power to the data centers. And speed to power is paramount for the hyperscalers racing to deploy AI infrastructure.
So where is the fastest return on investment in power generation right now?
This imperative is most constructive for renewables in the near term. Renewables are the quickest generation source to deploy right now to meet AI power demand because they face fewer supply chain, logistical, and permitting constraints compared to competing sources like natural gas or nuclear. The investment opportunity is in the infrastructure required to build out the grid connectivity to utilize that clean power.
There's also a significant labor risk wrapped up in this megatrend that ties directly back to our discussion of anticipated Fed easing. The U.S. and European power industries, they need over 750,000 new workers by 2030, particularly for complex roles in electricity transmission and grid hardening.
This demographic dilemma means that access to talent and advanced productivity solutions, those very forward AI applications designed for augmentation, not just automation, will become a key competitive advantage for large utility and infrastructure companies. They need tools that make their existing workforce exponentially more effective at complex engineering and maintenance tasks.
And finally, let's revisit the geopolitical risk from the macro section, applying the active positioning lens. Supply chain resilience and resource security are non-negotiable, durable themes for 2026.
The high U.S. effective tariff rate of 18% and persistent geopolitical tensions are accelerating the structural shift away from a pure cost efficiency model towards shorter, more resilient supply chains, driving onshoring and increased domestic production. This theme is durable regardless of who wins the next election cycle.
The risks here are existential for the AI boom itself. The sources highlight the critical risks inherent in current global dependencies. The world relies on China for approximately 60% of rare earth production. And even more critical for the future of AI itself is the reliance on Taiwan, which produces roughly 90% of the world's leading-edge semiconductors.
That Taiwan dependency is a source of quantum uncertainty, an unquantifiable catastrophic risk. This heightens the investment focus on companies aligned with the economic security theme, those providing solutions for resource security, energy independence, including U.S. LNG exports and national defense contractors who are crucial partners in this resilience effort. Active managers who can identify companies proactively building redundant, secure supply lines rather than just optimizing cost will be years ahead.
This has been a complete journey through a tremendously complex landscape. We started with a clear, data-driven 2026 investment outlook from Goldman Sachs, walked straight into the existential threats and promises of the AI boom, that tension between financial optimism and technical skepticism, and integrated a framework, Forward AI, designed specifically to proactively handle the dynamic, adversarial, and quantum uncertainty of this global, wicked environment.
The core lesson here is strategic and, well, philosophical.
Mm-hmm.
The current AI debate, the massive capex, the technical limitations, the financial circularity, it's the result of the industry being caught in the backward AI trap, focusing only on predicting the patterns of the past. The value created by Dr. Malhotra and his peers over decades, adding trillions to the market through systems that proactively anticipate and thrive on surprise, shows that the true path forward is the transition to forward AI.
That shift from data-driven prediction to outcomes-driven anticipation is not just a technological refinement. It is indeed the most significant paradigm shift in artificial intelligence since the advent of computing itself.
And ultimately, this shift reaffirms the enduring value of human cognitive capacity in a chaotic world. If we return to the concept of the quantum mind and the human as the active scientist, the one who must overcome their own biases and synthesize knowledge, the most enduring competitive advantage in this complex landscape is that human capacity, intuition, creativity, and insight.
The ultimate goal, then, is not to be replaced by the tools we build, but to maximize the ability to think beyond them.
Precisely. We must design, master, and, ultimately outsmart our tools so we don't become what Henry David Thoreau warned against, the tools of our tools. The power lies in our ability to always choose to rebuild our mental frameworks or constructs to create a better reality, leveraging that Hegelian conflict between market thesis and technical antithesis to force a positive synthesis.
So, given that the industry is finally realizing the limitations of simply scaling current LLMs, what unexpected, non-data-driven synthesis are you going to engineer today to position yourself years ahead of the next wave of technological progress?